Welcome and thank you for taking part in the advisory group's Pyramid of Success webinar. As you transition into the adulthood or get your career underway, or perhaps you're in a pivotal time where you need to look carefully at what the future holds, we feel that the tips and techniques we will cover may help set the stage for you to reach financial success. Now, let's first start with some introductions. My name is Manny and I'm a senior advisor with the advisory group. Also joining me is Brent Beverly, the president of the advisory group. Both of us are certified financial planner practitioners, CFPs. Now, before we begin, it's always important to review that there are 5 key areas of financial planning. These include protection planning, retirement planning, tax planning, investment planning, and estate planning. Now, as a comprehensive financial planning firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Now, during this webinar, we will primarily be covering the areas you see highlighted there on your screen: investment planning and estate planning. Let's talk first about the structure for your planning. Now, on your screen there is what we refer to in our organization as a tag pyramid. It represents a structure with different levels of priority to address and potentially seek. Now, at the very bottom there is your foundation. This includes the items you need to have in place and that we encourage you to satisfy. The estate documents such as your will and healthcare directive, your insurance policies to protect your loved one and hard-earned assets, and your home. Now, next up are your reserves. Your emergency funds that you have to keep on hand, likely at a bank, for immediate access should the unexpected and costly arise. Now, this level of liquidity sacrifices potential growth, which again is why it can't be at too high of a level. Next up are your income-producing investment assets. Now, these are considered safer than equity assets because of the fixed rate of return. These require investment dollars, but they have rates of return that aren't going to experience significant growth. Now, following this are growth and income-oriented investments. Now you're taking on more risk by investing in equities and exposing yourself to the ups and downs of the stock market. Here, you may be investing in companies that have the potential to grow at an above-average rate, or those that pay out dividends but aren't going to experience significant growth. You then have your growth investments. Now, you're at a riskier level with your stock exposure made up of the growth investments we talked about in the previous level, and you're now potentially adding on international stock with a lot of room to grow. Finally, at the top, we have the exotic level. Now, this is one where we will not provide much of any guidance. Collectibles, precious metals, lottery tickets, Bitcoin, they may all be nice to own and keep your fingers crossed on, but we simply will not structure them into a financial plan or depend on them. Now, most people have 3 likely sources of income to meet their obligations and discretionary needs in retirement. So when we say obligations, we're referring to bills and other required expenses. When we say discretionary expenses, we mean those that one can go without should they need to tighten the belt, such as going to the movies, going out to eat, taking hobbies, etc. So think of this as a 3-legged stool to provide financial support for people in their retirement. The first leg is Social Security. Now, despite headlines in the media, we do not expect the system to completely go away, despite its depleting budget, because it is simply a public good that is too heavily relied upon. Now, with that said, there are certainly challenges facing the Social Security system, so in all likelihood, actions are going to need to be taken. Now, we may see the full retirement age increase or benefits may decrease. So with savvy planning and preparation, Social Security does not have to be the primary source of one's income during the retirement. Now, the second expected source of retirement income is a pension plan. Now, once upon a time, pensions were quite common for workers who spent their career with one company, and upon retirement, they may have been given a fixed monthly pension for life. Those are more and more rare now, especially in the private sector. Most companies instead provide employee-funded pensions, primarily from salary deferrals, the most common of which are 401ks. So, while workers are no longer tied down to one company for the purpose of securing that pension, the responsibility of setting up and funding a retirement pension has now been bestowed upon them. Your 401k can follow you wherever you go, and various investment vehicles are consolidated with future 401ks should the employer allow it. The third leg is what you put away for yourself. It requires you to be proactive and direct excess cash flow towards your own private investments. Now, there are various types of investments with different suitability features that are designed to help various needs. This is why when you meet with us, we ask many questions regarding your personal situation so that we know we are making appropriate recommendations. The Social Security system is, for most people, mandatory to fund. As for a 401k, once you flip the switch, your deferrals should fund it automatically, and it requires minor diligence to keep moving forward. Many companies even match a portion of your contribution to help you with your retirement savings. Private investments, however, that third leg, require the discipline to save that excess cash flow and write the check to transfer those funds to the appropriate investment, knowing that you may be sacrificing short-term discretionary satisfaction for long-term prosperity. Now, the key point from these sources is that you need to take care of yourself. Do not count on government entitlement programs to take care of the bulk of your retirement needs. And the sooner you're able to begin, the smoother the ride will be. Now, investments can be complicated, but let's work to keep the concept simple. For many years, investments were divided into just three asset classes: cash, bonds, and stocks. Now, cash is pretty easy to understand. On top of the cash in your wallet, we include the money you have at the bank. The goal here is liquidity, being able to use the money quickly and easily, as well as safety of principal. Now, money in the bank has FDIC insurance on it, providing a guarantee of your money up to $250,000. Bonds are investments where you lend money to someone, typically a government or a company. Now, included in the bond are important details, such as how much interest they will pay you and when they will pay you the interest payments, as well as the maturity, which is when they will pay your investment back. Now, it's important to know to whom you are lending your money and what is the source of the repayment to you. Stocks, on the other hand, represent ownership in a company. If you own part of a company, the value someone is willing to pay you for your ownership will depend on the prospects for that company to make money. For example, if Amazon's prospects go up, you would expect their stock price to go up accordingly. If Amazon were to face issues, you would expect their stock price to go down. So let's talk a little bit about risk. Now, many investors focus on risk solely representing the susceptibility of an investment to drop in market value in the short term. So if a stock can go down in price 30% in a month, that is indeed a very risky stock. But there are also risks involved with not providing your hard-earned assets some growth opportunity. You see cash down there at the bottom, good old cash. It's considered the least volatile and thus regarded as the least risky vehicle in terms of value fluctuation. And with FDIC insurance, the government will even step in and make you whole up to a certain level should the banking institution fail. But cash does present another risk, purchasing power risk. So if you keep an excess level of cash sitting on the sidelines for a long period of time without even the need to access it, you are likely to be eroding its purchasing power. Now, we will address inflation in more depth in a couple of slides. So what is a good way to get into diversified investments without a lot of money? Now, many people have access to mutual funds for their investments. Mutual funds are a way for you to pool your investments and hire professional management. Your 401k plan probably only has mutual funds as the investment vehicle. So what are mutual funds? Let's say you want to buy stocks. So if you were to buy 100 shares of Amazon, it would run you over $245,000. Not many people can or even want to sink that much into a single stock like that. So it would perhaps be more prudent to have a diversified portfolio consisting of various stocks. So if we decide to pool our funds together, we can accomplish that. If everyone listening in here were to put in their money all together, we would have a nice pool where we could buy multiple stocks and afford to hire a professional manager to buy and sell those stocks for us. Now, this is exactly what a mutual fund does. It allows people to pool their funds together and those of thousands of other investors and have our pool of funds managed by a professional money manager. Some people, when they invest, they want long-term growth and not have to worry about short-term volatility. Others want to have moderate volatility and maybe more income. Some want to have their money manager just buy bonds, while others want a mix of stocks and bonds. Now, that is why there are so many mutual funds out there. As of 2019, there were over 123,000 mutual funds around the world. Each one has different objectives, different managers, different costs, and different rules. And you can find all of these attributes outlined in the fund prospectus. Now, mutual funds have different minimums. You can get started in some funds with as little as $25. Others have much higher minimums, so please check the fund that you may be interested in. Now, this is an important point. Most publicly traded mutual funds trade at the end of every market day. So if you put your order to sell into the beginning of the day or the end of the day, it doesn't matter. You get the price of the mutual fund at the end of the day. Now, this is in contrast to stocks that fluctuate throughout the trading day. So how do taxes and inflation affect your real rate of return? Now, you start with your top line rate of return. Now, we're going to use round numbers here for simplicity. So let's say you open a high yield savings account paying 1% interest. Now, we know that seems really small, but these days that's a higher rate of interest than you're probably earning on your bank account. 1%, that's literally 100 times what a traditional brick and mortar bank is likely to pay you. And you still have to pay taxes on that 1%, as small as it may seem. So we're going to use the 24% tax bracket here to take away from that 1% earning, leaving you with a 0.76% after-tax rate of return. Now, to use real dollars, if you invest $10,000 into the savings account at 1%, you're going to get $100 a year in interest. And that $100 results in a tax bill of $24, leaving you with $76, after all is said and done. Finally, we take into account the inflation rate. Now, this goes back 2 slides when we mentioned cash being subject to purchasing power or inflation risk. Now, those funds sitting in the bank earning 0.01% are unlikely to have the same purchasing power with each month that passes. More so during these high inflationary times. Now, we're seeing rapidly increased inflation of over 8%, but for this exercise, we'll use the more moderate 5%, as you see there on your screen. And when you subtract that taxation and inflation, you get the real rate of return. So in the end, after factoring in taxes and inflation, your 1% rate of return actually netted you a negative 4.24% real rate of return. And these days, it's probably even lower than that. Now, when you do this calculation using bank accounts and short-term bonds, usually your real rate of return is going to be negative. This is what we refer to as going broke safely. And this is the concern we have with having too much in cash. Now, after taxes and inflation, cash typically loses spending value over time. So when we talk about risk as far as investing goes, it takes on different forms. So how do you beat taxes and inflation with your investments? Now, what has delivered returns above taxes and inflation for generations has been what we call ownership investments. Those are investments such as stocks or real estate. When we talk about the ownership investments, we know that they come with volatility. That means that ownership investments, especially stocks, go up and they go down. Our focus for a long-term plan is how they perform long-term from point A to point B, again, realizing that there will likely be big fluctuations along the way. It is not meant to be a smooth, comfortable ride, but they do provide the biggest opportunity for long-term growth. Now, the biggest difficulty with long-term investing in these volatile investments is that they go through their cycles of up and down. Our emotions make us do the wrong things at the wrong times. We see many investors experience disappointing returns because they have an emotional, undisciplined approach to investing. Now, what we have in this chart on your screen is the typical emotional cycle as it relates to investing. As you begin to invest, you're fearful. Perhaps your past recessions or down markets and the thought of losing every dollar you're investing. However, your investment rises in this example, and you begin to feel hopeful and optimistic that your investment is going to rise even higher. And sure enough, it does. You're then feeling greedy and you think there's no stopping this investment, so you buy and you buy big. And as the market continues to advance, greed inevitably sets in. Lots of buying takes place at this level when investors are extremely enthusiastic about the market. It seems like the markets are going to go up forever, and Some experience the FOMO effect, the fear of missing out, that the investment is going to take off, so you better be fully on board. But other people may disagree and start selling out of it, and the investment will go down. Now you're hoping the downturn is limited, but it continues to drop. And pretty soon you're back to hope. You hope it doesn't go down even more, but it does. In fact, it drops so much that your investment is now below what you started at. And you're so fearful at this point that you may be considering getting out altogether, booking an overall loss, and giving your investment no chance to recover. And should you keep yourself from selling, the cycle's just going to keep repeating itself. So you go into the investment knowing full well that the secret ingredient is to buy low and to sell high, and you let your emotions steer you into doing the complete opposite. Now, this is a common experience for many investors, and it demonstrates how an emotional response to volatility and risk could lead to disappointing performance. As advisors, we're here to take on that emotion on your behalf and provide the objectivity that helps you stick to that original game plan. We expect the ups and downs, and we do not respond with knee-jerk reactions during the downtimes. Investing 101 tells us that there's a simple formula to being a successful investor. Buy low and sell high, and repeat that over and over. Now the problem is, and it's a big problem, no one knows when the market is high and when it is low. Now, we speak with highly qualified industry professionals on a weekly basis, and we hear conflicting opinions on where markets are headed, despite great supporting evidence for whatever their case may be. There is a plethora of data at our disposal on where markets should go, but if all these practices were a certainty to selling at the right time, everybody would be a millionaire. So what is the advice we can give you with this in this regard? Do not try to time markets. The markets will fool you, they'll fool us constantly. We're going to take a look here shortly at how even in a rock-solid economic environment, investors' emotions do cause corrections. Now, these are very basic fundamentals shown on the screen, but here is how the world really works. First of all, history has provided great evidence that markets go up and markets go down. Now, since no one can time markets, we need to have a real plan for investing. And not all investments are alike. Some are riskier than others. We showed the graph earlier of cash, bonds, and stock in order of least risk to most risk. Some investments are just more volatile in the short term than others. Other investments may be more stable in the short term but face loss of spending power in the long term. So there's no single investment that fits all of your needs. You have to have diversified investments. By diversifying your investments among the different, it's in a mix that fits your needs and goals, you can help control your investment risk. Also, there's no single investment that is suitable for every investor. This is why we get to know your circumstances, goals, your feelings on risk, and we help recommend investments that are suitable for you. Now, what is the biggest problem most investors face? Emotion. We alluded to the fact that the most positive economic data and headlines cannot overcome investors' emotions. A company could be prospering tremendously, but let's say the CEO were to get caught up in a personal scandal, investors may very well shy away from that company, sell out of it, and its stock would then drop accordingly. Now, one of the main costs in economics is known as opportunity cost. It deals with the opportunities that one bypasses by taking action in another. So if you're spending $300 a month golfing, as enjoyable and as happy as golfing makes you, the opportunity cost is what you would otherwise be earning and accumulating should you invest that $300 into preparing for a successful retirement. Now, we're all for enjoying life, of course, but that's simply what the opportunity cost is. Now, a common goal someone may have is to become a millionaire. We've glamorized the term millionaire, but it's certainly achievable. In fact, not just achievable, but perhaps even necessary for a reasonably comfortable retirement. So if we look at the chart here, the earlier you make those sacrifices, bypassing a bit of discretionary spending and instead directing it towards long-term growth-oriented vehicles, the easier it may be achieved. So if you were to begin at age 20, which is by no means a small task for a college sophomore or junior, you would need to invest a fixed $285 per month for the next 40 years to reach $1 million in investments by age 60. This is assuming an 8% annual rate of return. If you do the math, $285 times 12 times 40 is only $136,800 that you put away. The power of compounding is an amazing phenomenon. Your earnings themselves yield earnings and over time have the potential for such significant growth. So just $136,800 turned into that $1 million. Now, if you were to get started late, perhaps because you weren't encouraged to invest or you didn't have the excess cash flow to get started in such a disciplined plan, let's say you waited until age 30. At this point, you have lost 10 years of potential growth and compounding from the previous example. Here, you'd need to invest $667 per month to reach that $1 million by age 60. Now, this is a factor of nearly 2.5 that if you had started out at age 20, and a grand total of $240,120 of total funding. Now, if you were to wait until age 40, you now only have 20 years to invest, and you'll have to put away $1,686 monthly, which is a total of over $404,000 in funding, and the numbers just get uglier the longer you put this goal off. So how should you invest? Now, every single client we meet with and every investor have different needs and circumstances. Again, there is no one-size-fits-all investment out there suitable for everybody. You need to work with your personal financial advisor to set up the portfolio that achieves your goals, meets your needs, and is within an investment program that allows you to sleep at night without worrying about your investments. Now, developing a successful strategy and a disciplined game plan begins with the completion of a risk tolerance questionnaire. Everybody's built differently, and some respond to the consequences of risk more than others. Now, this is one of the key factors we use to determine what recommendations are appropriate. We then design the right mix of investment selections to meet your goals, your needs, and your capabilities. So often the question at this point is, it all sounds great, but where do I get the money to invest? We all face spending temptation throughout the day. It's always easier to spend money than to save money, even for important goals. Many people like immediate satisfaction, so it takes a different level of mindfulness to really consider those long-term goals and how you need to potentially fund a retirement period that may very easily last 3 decades. So most people that have the ability and desire to begin investing on their own use the traditional method. They get their paycheck, taxes are withheld, they pay their bills and other monthly expenses, and they invest whatever is left, if there's anything left. Not surprisingly, there usually isn't anything left. So the method we recommend to help build up the bulk of those assets earmarked for your retirement needs is to fund your planned investments first. With a disciplined plan in place, you could set aside some or all of these funds before you pay taxes on them, thereby investing money that would otherwise immediately go to the government in taxes. Now, naturally, most people find it easier to live on the money they can touch. Oftentimes we hear, if I don't see it, I don't spend it. So use that to help you monitor your spending and still fund for your other goals. Tax rates. As you can see, there's a stair step, and you only pay the higher tax on the portion of your income that actually goes into that higher tax bracket. In other words, any income you have coming in that is taxed at the 10% rate is always taxed at 10%, even if you have enough income to be paying 35% on some portion of your income. Now, if you have some income tax at 35%, you will have portions of your income taxed at 32%, some at 24%, and so on, all the way down to some taxed at 10%. So you're never worse off making more money. Just know that you'll get a larger chunk taken out of some of those higher dollars. Now, just for the record, there are other taxes that may be added to increase your marginal tax bracket, primarily state taxes. Here in California, if you were at that highest federal tax bracket of 37%, you would be paying over 50% combined, federal and state. There are 3 ways to save taxes on investments. Now, if you're able to put money into a tax-deductible pension plan or IRA, those funds are calculated at the highest marginal tax rate that you pay. So if you're in the 24% tax bracket and you put $100 into a pension deferral plan, your income only changed by $76. The other $24 came from taxes that you no longer have to pay this year because your contributions, if eligible, are deducted from your income. Think of it as buying $100 worth of investments with a $24 spendable refund in the end. There is a tremendous advantage to these tax-deductible contributions. Now, another advantage of pension plans or IRAs is that while they grow, you do not pay tax on any growth. Dividends and interest that the underlying mutual funds or stocks pay don't subject you to an annual tax form. The term for this is tax deferral and is another huge benefit of a tax-advantaged vehicle. So you never have to worry about receiving tax forms annually for these. Now, the government makes these advantages possible, not out of the goodness of their heart, but to encourage you to fund these retirement assets and become much less reliant on them in the future. Now, the third way is to have the distributions come out tax-free. Distributions for a Roth IRA or 401k are tax-free. Principal where you have already paid tax typically come out tax-free. Now, the best you could do is 2 out of those 3. And if you're not careful, you may only get 1 out of the 3. For example, your typical bank account is not deductible nor deferred, but when you use the money at the end, since you have already paid tax on the principal and earnings, you get your distribution tax-free. For a traditional IRA, you get 2 of the 3. You get the deduction when you put money in, you have tax deferral while it grows, but you get to pay taxes when you withdraw the money. Now, beyond the underlying investments, another decision to make is what investment vehicle to use. Now, which is better? Each has certain advantages and disadvantages. Now, pension plans such as 401ks or IRAs are tax advantaged, in most instances allowing you to deduct your contributions from your income and deferring taxes until withdrawal. Now, these are huge advantages, which is why we look to cross these off the list before venturing into non-qualified or taxable investment accounts. Now, sometimes we get calls from people asking us if we can help them open a brokerage account where they can buy tech stocks to their heart's content. If we get to know them and we come to find out they're not contributing to their 401k at all, or as much as they should be, we steer them in that direction instead because it provides a greater advantage. Now, pension plan matching is also a huge advantage. If your employer has a proposition of, for example, matching 100% of your contribution up to 3% of your salary, that could be thousands of dollars that they will add to your 401k. This is why we focus so much on pension plans being offered by your employer and encourage you to defer as much of your salary as possible within the maximum guidelines. The caveat, however, is that you have very little control over the underlying investments. Now, you may be presented with a diversified yet very limited list of investment options from which to choose, and as advisors, we're happy to make the most of them and provide you with our recommendations. Now, assuming you qualify for a deductible traditional IRA, if you don't have matching at work or you don't exceed the income thresholds to contribute to both your company plan and contribute to such an IRA, this is a valuable tax-advantaged vehicle. An IRA also has the advantage of allowing you to control the investment. Now, you can control the timing of the funds going in or transferring between investments. You can select the investment managers who best fit your needs, not just among a handful of managers selected by your company. An advantage of a 401k is that it is funded by taking money out of your paycheck, but with an IRA, you write out a check. Now, as we move to the third very broad vehicle, we look at what we refer to as non-qualified investments. Now, those without the valuable tax-advantaged vehicles giving you the greatest flexibility and control in the short term. Unfortunately, it also hits you with the highest taxes. Now, if your investment is generating dividends and interest throughout the year, you're going to receive a 1099 and pay for that income accordingly. So if you've exhausted the limits on the pension plan and the deductible IRA and you still have excess cash flow, certainly discuss with an advisor ways to make those funds work for you. Non-qualified investments are also appropriate for additional liquidity prior to retirement. Now let's take a look at individual retirement accounts or IRAs closer. Now there are 2 main types, traditional or Roth. A traditional IRA holds the advantage of allowing you to deduct any money from your taxable income so you avoid taxation on those funds until you pull them out of the plan and spend them. Now down the line, when you take money from your IRA to spend, you will add that income to your taxable income for the year. A Roth IRA provides that you pay taxes on your contribution now, preventing any tax deductions. So you're taking after-tax dollars and funding the investment, and if you meet the criteria, you may withdraw them tax-free in the long run, no matter what the growth. This is a huge potential advantage. So since you can do the same investments in either format, rates of return along the way do not differentiate which is better. To determine which is more appropriate, you need to look in the future and estimate the tax brackets when you plan to pull the funds out of your pension or IRA and compare them to the tax bracket you are in today. Typically, if you're just starting in your working years, you'll be in a higher bracket during your retirement years than you are in the present day. That would lead you to fund a Roth IRA. Now, if you're not sure, figure you're in a high tax bracket, we recommend taking the current deduction. There's an old saying, a bird in the hand is worth two in the bush. As attractive and advantageous as IRAs sound, you're limited to how much you may fund. For each person, the maximum amount is $6,000 or $7,000 if you're over the age of 50. Now, these are subject to increase as determined by the government. Now, I want to bring up our next speaker to cover another vital area of your financial well-being. So let me introduce Brent Beverly.
Well, thank you, Manny. Man, you covered a lot. Well done. We're going to switch subjects now from the fun of investing and seeing things grow to a little bit more morbid subjects like death and disability. Now, I don't want to be a downer here, but we all need to face these events in our lives that can occur at any time. So this may come as a surprise to you, but as an adult, you're responsible for yourself. Your parents are not automatically able to step in and take care of these things for you. So let me make a big blanket statement here. Every adult should have a will and the associated documents that we're going to discuss here, regardless of their age or situation. So if you're a legal adult, you need these documents. Now, only 53% of people ages 30 to 55 with an annual household income of $100,000 or more have an estate plan. And only 32% have a will, according to a survey from an estate planning firm, Wealth. Among the top reasons that people don't have any estate plan is because they're thinking, oh, it can be done later, and assuming that it's something that only wealthy people do. That's what the survey found. Now, to be clear, a will is the document that takes care of your affairs after you die. Now, you probably already have a will because California has what's called a statutory will, in case you have not done your own document. Now, you most likely would not want to be in agreement with what a California statutory will actually says. Now, if you have a statutory will that California provides by default, your estate could get eaten up by legal costs as the courts decide what to do with your assets. We jokingly say the statutory will gives half of your money to the attorneys and half to the state, and your heirs get the rest. It may not be too far off. More importantly is if you have kids and don't have an up-to-date will, or worse, don't have one at all, it is crucial that you get one done. Do you really want some random court deciding on who will take care of your wishes and your family? Now, we hear horror stories about unsuitable guardians becoming responsible for their children simply because they fall within the family line. Make sure your wishes and directions are clearly expressed on the legal documents. Now, in case you haven't noticed it, I'm getting on my soapbox here. Let me do a little preaching here. If you use a typical will, you are simply creating a disaster for your children. Don't do that. Now, let me give you an example. I want to share with you. A friend of mine at Rice University, where I went to school, my friend was fortunate enough to be on a full Navy ROTC scholarship. And then when he turned age 18, he received an inheritance of $180,000, more money than any of us had seen in our entire lives. Now, this led to a sad chain of events, though. With that money, he dropped out of school, dropped his scholarship, bought a big black car, and took off. A year later, the money ran out. No money, no scholarship, no college education. In my opinion, he lost his chance at a great future. All of this could have been totally avoided if his parents had planned and taken care of their legal affairs by directing how much of the money would come to him at what point in his life. You can imagine their train of thought, though. We just don't even think about it, right? If anything happens to me, I leave it to my children. Help him out in life. Asking even the most responsible and disciplined 18-year-old to handle hundreds of thousands of dollars is simply setting it up for disaster, as was indicated in this case. So please, don't do this. Make sure you don't destroy your child's future. Get your wills done, spread out the distributions with specific life goals for your children. We also meet with people who've written down their wishes on a piece of paper and think that's all they need. Now, a will that's completely handwritten is called a holographic will and could very well be enforceable. But that's usually not a good idea. What seems clear to you when you write the document may not be clear when you're not there to explain it. Your wishes could very easily be misinterpreted if they lack specificity and legal terminology. How's that for a nice term? A good example, all right, this is one we saw, was a guy who wrote, "I leave everything to mother." Seems pretty clear, doesn't it? Well, his ex-wife claimed the money was hers, saying that he had always referred to her as mother. And in the end, she did receive a substantial portion of his estate, probably not what he really intended. This is why we strongly recommend that you meet with an attorney who specializes in estate planning. We find that most attorneys say they can put together wills, but not all of them know the ins and outs of creating estate documents. Often they just have the software and templates on their computers. Worse yet, there are do-it-yourself programs and online businesses that will ask you a couple of questions and then generate the documents. Now, as an example of this, I was using a program early in my career. I was going, I know this stuff pretty well. I can do this. And so I went and pulled up a program to give me the framework, and I said, okay, here we go. Let's start going through and seeing how this will do. Well, okay, what happened was, as I went through there, I went, this is just wrong. Now, I knew enough to know that was wrong. I knew enough to know that it was dangerously wrong, and I went and hired a good attorney to take care of my documents. You cannot beat the face-to-face experience of dealing with a qualified attorney in drafting these documents. Now, we at the advisory group, we can help you find one with experience in preparing wills and these other documents. We also have forms available to help you kind of prepare mentally and get your thoughts down and get things together before you meet with the attorney. And so that attorneys tend to like that because it means you've kind of thought things through a little bit and they can focus on specific things that you need to do. Let's spend just a minute here on living trusts. Now, contrary to some of the advertising you may read, a living trust is not necessarily for everyone. While we recommend that everyone get a will to specify their wishes, and some of these other documents we're going to talk about here in a minute, a living trust is only needed under certain conditions. So when appropriate, living trusts are valuable tools. A lot of people we work with need them. But again, they're not for everyone. You want to meet with us, meet with your attorney to help you determine whether your situation and level of assets would benefit from having the ownership of a living trust. I also want to make one quick note here. Investments or policies which have stated beneficiaries are not controlled by your will. Your IRAs, pensions, life insurance, annuity policies, all these things have you state who the beneficiaries are when you set them up. If the beneficiary you selected for the policy is one person, let's call that person A, and your will says it goes to person B, well, the stated beneficiary is going to control and person A will get those funds. Now, there are other conditions that you should be aware of when stating your beneficiaries. So again, be sure to go over this with your attorney and be coached by your financial advisor to help avoid future problems. I'm going to get back on my soapbox here. If you're age 18 or older, you need these documents. Now, you may be under their medical insurance, or once you're an adult, your parents no longer have automatic authority to make these financial and medical decisions for you. The same attorney who prepares your will should also help you with these other documents that are vital in case the unexpected happens. So the documents you need to have are an advanced healthcare directive, a durable power of attorney for asset management, and a HIPAA release. Now, HIPAA stands for Health Insurance Portability and Accountability Act. You can tell why I call it the HIPAA release, all right? Let's review these in a little more detail. The Advanced Healthcare Directive. is a document that expresses your wishes regarding medical-related needs. Now, in some states, these are still two separate documents, usually referred to as the living will and the durable power of attorney for health care. So if you're not in California, if you're in a different state, again, work with your attorney locally, but you may see these different documents. Now, when an individual loses his or her ability to make personal health care decisions, the law in most states allows that person to designate another person, called a surrogate, to make those decisions, including the power to make end-of-life decisions. Now, that's pretty personal, and it's something you want your decisions to be followed. So the Advanced Healthcare Directive may also include things such as directions for pain medication, directions to provide, withhold, or withdraw artificial nutrition and hydration, and all other forms of healthcare, including cardiopulmonary resuscitation. A physician designated by the patient or the patient's agent, conservator, or surrogate to have primary responsibility for the patient's health care. Who is that person? And post-mortem powers to dispose of the remains or authorize an autopsy, donate all or part of your body to transplant, education, or research purposes. These are very individual decisions. You don't want somebody else making decisions that you may not have agreed with had you been able to make your own decisions. The durable power of attorney for asset management is a document that allows you to appoint someone to act on your behalf for legal and financial matters in case you're not able to handle these for your affairs. Now, this doesn't say you're dead. It says you're alive. You're just not able to take care of it. Let's say you have a car accident and you're in the hospital for a month or two. Who takes care of your stuff? Now, remember, your will does not have any effect until you die. If you're just incapacitated, whom would you want making these decisions and paying the bills for you? Without this document, someone would need to go to court and get a conservatorship for you. Now, that's expensive. It's time-consuming. It may not be the person you really want handling your affairs. We joke occasionally that the courts move at a speed that makes glaciers look fast. So, guys, get the document. The Health Insurance Portability and Accountability Act, the HIPAA authorization, is a document that allows medical personnel and doctors to communicate with your family and or others whom you may want to have information concerning your health. It allows the release of information and designates to whom the information can be released. So let me add a quick note here regarding the HIPAA release. Most attorneys like to keep the list of people who can learn of your conditions very short. Now, most people we know like to have that list longer. So think about who you'd want to be able to discuss your medical condition with the doctor. A significant other, a good friend, a close relative. Well, unless you have this document, they're not going to be provided with any details concerning your condition if they are not listed in the form. If you want them to be able to know, they should be on your HIPAA release. So let me say this again. Now that you're an adult, your parents no longer have decision-making authority over your life. These documents tell the courts, medical professionals, and anyone else who needs to know who can make important, life-affecting decisions for you in the event that you're not able to make them for yourselves. You cannot wait until you need these documents to set them up. They need to be prepared and signed in advance. Now, as you can tell, I'm a little passionate about this. I can share story after story of people who needed these documents and didn't have them, came up short. And I can even share some stories where having these documents saved endless time and effort. So catch us sometime. We're very happy to share some of those with you. Bottom line, get these documents in place as soon as you can. Now, Manny and I covered a lot today. And due to our limited time, we've had to condense various topics and discussion points. There are many factors to consider before you're able to properly evaluate your situation and determine the best way for you to meet your goals. Now, the advisory group's ready to assist you in determining your plan, coordinating it, getting your path to financial independence started. Those of you who already work with us know our first meeting is always complimentary, a chance for you to meet us and decide us to meet you and decide a course of action going forward. Now, we appreciate this opportunity to share some ideas with you and hope that you found this workshop enlightening and helpful. So, where do you go from here? Now, we realize this is a very condensed seminar and there are many other topics we wish we had time to cover. So we encourage you to examine your personal circumstances and establish an appropriate plan, no matter what your age, that will allow you to meet your goals. So we realize the circumstances of each person here is different from anyone else's. So we're happy to provide you with individual guidance and recommendations to not only see where you currently stand, but to determine the necessary steps to have the pieces in place to help you reach your goals. One of our main focuses as a financial advisory practice is to continuously review and evaluate changes for our clients on an ongoing basis. At this point, you're probably not a client of ours. However, we want you to get your life off to a good start. So we're happy to meet with you, happy to review your situation and get you launched in the right direction. Our first meeting, as I noted, is always complimentary. There's no charge and will be informational only. Because we feel so strongly on getting the proper estate and medical documents for everyone, we are willing to provide you with the forms and referrals to get you on track and moving forward. As you can imagine, we're in a heavily regulated industry and we are very mindful that every bit of information we provide to you. So we have some disclosures here. We realize your investment dollars are hard earned, and so we and the regulators want to make absolutely certain that we provide you with as much information as possible when you're looking to make these decisions. Because we're doing this on a recording, you can pause this, read through it. We highly recommend that. I'm not going to spend too much time on it. Let's move to the final step here, but do have a chance to read these. So we love it when people have learned new information, and I hope you found this informative and interesting. If you wish to set up an appointment with us to further discuss any areas of concern, not only based on this presentation, but as they pertain to your other financial affairs, please reach out to us on the phone number or email address shown on the screen. The best person on our tag team to set up a meeting with one of us is Melinda Smith at extension 209. Mel is our corporate concierge, our client concierge, and she takes care of scheduling things for us to make sure we're in the right place at the right time doing the right thing. Again, I want to thank you for listening and going through this. We look forward to meeting with you soon. Best wishes for a successful future.